Good morning and welcome to the September 2025 meeting of the SEC's Investor Advisory Committee. I am Brian Shore and I am Chair of the IAC. Before we get started, I'd like to turn the microphone over to Andrew, who will conduct a roll call. Andrew?
Thank you, Brian. Good morning, everyone. I will now call the roll. James Andrus.
Here.
Rodney Comegys.
Here.
James Copeland.
Here.
Christina Martin Fervita. Not present. Gina Gale Fletcher. Not present. George Georgiev.
Here.
John Gulliver.
Here.
Colleen Honigsberg.
Here.
Craig Kanoki.
Here.
Christine Lazaro.
Here.
That's virtual. Nancy Lamond. Not present. Amy McGarity. Not present. Andrew Park.
Here.
Dr. David Royney. Not present. Sergio Rodriguera, Jr.
Here.
Attending virtually. Paul Roy.
Here.
Brian Shore. Here. Jennifer Schultz.
Here.
Andrea Sight.
Here.
Alvin Velasquez.
Virtually.
Back to you, Brian.
Thank you, Andrew. Today's meeting presents a two-part panel discussion and one recommendation for consideration. Before we turn to our formal agenda for today, I'd like to welcome four new members to the IAC. Rodney Comegys, James Copeland, John Gulliver, and Sergio Rodriguera. Today's panel, which was said will be in two parts, is entitled Reconsidering the Eligibility Criteria and the Regulatory Treatment of Foreign Private Issuers, otherwise known as FPIs. The panel will be exploring the evolving landscape of FPIs, a topic that sits at the intersection of global market access, regulatory design, and investor protection. The panel is prompted by the SEC's June 4, 2025 concept release. The first panel today will run from 10:30 a.m. to 12:30 p.m. and will be followed by an administrative session. The second panel will start our afternoon session at 2:30 p.m. Over the past 2 decades, the FBI ecosystem has shifted in profound ways. Many issuers are now incorporated in offshore jurisdictions, headquartered elsewhere, and trade almost exclusively in U.S. markets. At the same time, they benefit from significant accommodations under the U.S. securities laws, exemptions from quarterly reporting, insider trading disclosures, domestic governance requirements, among others. These trends raise important policy questions. Is the current definition of FPI still appropriate? Do the associated regulatory accommodations remain justified? And how should the SEC respond to structural changes in global capital markets while preserving access, fairness, and oversight? In part one this morning, we'll begin with a global review, examining how the FPI framework has evolved, what international patterns have emerged, and how other jurisdictions are approaching cross-border regulation. At part two, which will begin at 2:30, we'll turn to practical and legal perspectives, including the views of institutional investors and legal practitioners on the implications of potential reforms. We're fortunate to be joined by a distinguished group of speakers across both panels. Moderating our discussion is Professor George Georgiev of the University of Miami School of Law, who's a leading expert on securities regulation and corporate governance, as well as a former capital markets lawyer who has worked with many foreign private issuers. Following the second half of the panel, the members of the Investor Advisory Committee will engage in a discussion and consideration and vote on recommendations regarding retail investor access to private market assets. I look forward to the thoughtful panel discussion ahead and the discussion concerning our recommendation. Now we will turn to opening remarks, first from Chairman Atkins and then the other commissioners. Chairman Atkins.
Well, thank you very much, Brian, and good morning, ladies and gentlemen. It's great to be here and a pleasure to be in person, and this is my first time with the committee as chairman. So I've long believed that the Investor Advisory Committee has an important mission to give considered input to the commission. And I should like to thank you for your dedicated service, especially those of you for whom today marks your first meeting of the committee. We're excited by the perspectives that you all bring to the committee and by the ways in which you will enhance public dialogue on key issues facing investors. Now, of course, I should also like to extend a warm welcome to today's moderators and panelists, including two distinguished participants from the United Kingdom's Financial Conduct Authority, Ashley Alder and Helen Boyd, whom we are very honored to have with us to discuss the evolving landscape of foreign private issuers in the U.S. capital markets. Having just returned myself from the UK and Europe, I had a chance to address this very topic, and I can say how timely today's panel is. It's also very timely and fitting for the FCA to be represented here today in light of the long collaboration of our two countries in the financial markets. Both of our countries have vibrant capital markets, and I look forward to working with our UK counterparts to enhance our mutual cooperation and harmonization of regulatory approaches to promote innovation and economic growth. As I stated last week in London and before the OECD in Paris, strong sovereign nations like the United States must continue to engage constructively in the world in ways that promote our prosperity. And at the SEC, these priorities find expression in our work to attract foreign companies to the U.S. markets and to provide Americans with the opportunity to invest in those companies while ensuring that U.S. and foreign firms experience a level playing field. In the early 1980s, the SEC developed the foundations of its current standard for which foreign companies qualify for special accommodations. These accommodations recognize the differences in business and market practices, accounting standards, and corporate governance requirements, among other matters, between the U.S. and foreign companies. Over the decade, the SEC has reassessed and reformed its standard as needed to address changes in the global markets and to protect U.S. investors. In one of my first actions as chairman, I asked the Commission to approve the issuance of a concept release to gather public feedback on whether the standard should be updated to reflect the evolution in financial markets and corporate legal structures. This concept release solicits broad public feedback on whether foreign companies listed in the United States should be subject to additional conditions, such as a minimum foreign trading volume or listing on a major foreign exchange, for them to receive accommodations not available to U.S. companies. Now, to be clear, the SEC welcomes foreign companies that seek to access the U.S. capital markets. I must emphasize that the concept release is not a signal that the SEC intends to disincentivize such firms from listing on U.S. exchanges. Rather, our goal is to better understand the impact on U.S. investors and the U.S. market resulting from significant changes to the population of foreign companies listed in the United States over the last 2 decades. Among the notable changes are the makeup of foreign companies reporting to the SEC and the trend of incorporating in a jurisdiction such as the Cayman Islands that differs from where the company is headquartered, operates, and is subject to a governance framework that implicates shareholder interests. In light of these changes, I believe that it behooves us to consider whether the SEC's original rationale and current standard for extending special accommodations to foreign companies still make sense. Retrospective reviews of our rules to evaluate whether they continue to achieve their intended policy goals is one of the hallmarks of an effective regulatory agenda. And I look forward to reviewing the robust public feedback and, of course, this committee's input on this topic. Today's second panel, meanwhile, will explore the regulatory framework governing retail investors' access to private market assets. To its core, I believe that this conversation is about freedom and fairness. It's about the idea that exposure to the full dynamism of our markets should not be reserved for the wealthiest or for those deemed to be the most sophisticated. For context, from 2002 until very recently, the sale of closed-end funds investing 15% or more of their assets in private funds was limited to investors that satisfy the accredited investor standards. Consequently, for over 20 years, retail investors who were not accredited lacked the opportunity to gain exposure to private assets through such vehicles as private equity and hedge funds. Earlier this year, I directed the SEC staff to reconsider this position, and as a result, funds will no longer receive comments to this effect during the registration process. This change reflects profound shifts that have taken place since 2002, including the accelerated growth of private markets, the increased oversight and enhanced reporting by both private fund advisors and registered funds. In the last decade alone, private fund assets have almost tripled from $11.6 trillion to $30.9 trillion. Allowing this option could increase investment opportunities for retail investors seeking to diversify their investment allocation in line with their investment time horizon and risk tolerance. In that spirit, I was therefore delighted by President Trump's executive order to democratize access to alternative assets. The Commission is exploring ways to facilitate the ability of individual investors to participate in the private markets, while at the same time protecting those investors from bad actors and from fraud. There is investor demand for these products, but we also have to have appropriate guardrails to guide proper investment of retirement and other funds into these private vehicles. We must address the important issues and potential pitfalls inherent to this genre of investments, including liquidity, valuation, diversification, and strategy, terms and conditions of investment such as investment priority and relative investment seniority in the capital stack. These sorts of questions cannot be left to chance, and fiduciaries who have a long-term retail clientele must understand their duties and investor expectations. As the Commission works closely with the Department of Labor on implementing the executive order, I very much welcome today's discussion on recalibrating the existing regulatory framework and working on these fundamental practical issues. So before I close, I'm grateful once again to all of our committee members, moderators, and panelists. Thanks also to our investor advocate, Christina Martin-Fervida, and her staff for their diligent efforts in organizing today's meeting. Your contributions help to ensure that our work remains both rigorous and responsive to the interests of investors. So I convey and share in the agency's appreciation for your service, and thank you, and please accept my best wishes for a productive meeting.
Thank you, Chairman Atkins. Next will be Commissioner Peirce for opening remarks.
Thanks, Brian, and good morning, everyone. Welcome to all the committee members, particularly our newest members, Jim, Rodney, John, and Sergio. I'm grateful that you've agreed to lend your talents to the committee. I'm looking forward to today's panel discussion on foreign private issuers in the U.S. capital markets. Prompted by the Commission's recent concept release, which the Chairman just described, the panel will help us discern whether a regulatory response to changes in the composition of FPIs is warranted. The SEC has afforded accommodations to FPIs based on an understanding that these companies are subject to meaningful regulation and disclosure obligations in their home jurisdictions. I would appreciate hearing your thoughts on whether FPI disclosure is adequate, and if not, where there's missing information that would help investors make informed investment decisions. I appreciate today's panelists for joining us in what I expect to be an excellent discussion that will supplement the comment file on the concept release. Particular gratitude goes to our participants who came all the way from London. Thank you to Ashley Alder, to Helen Boyd, and also to John Horsfield Bradbury of Sullivan and Cromwell. Perhaps our London participants would have appreciated if we had had this meeting before, during the time when their city was beset by a tube strike. The photos of streets jammed with cars, pedestrians, buses, and masses of strikalists who are stressed out, suited, wobbly commuters on bikes for the first time in years evoked sympathy in this city, which is also a city that relies heavily on public transportation. Some people, when they think of retail investors in private markets, seem to see images of unsteady, unpracticed bikers careening down streets full of obstacles and potholes and danger. These people think that training wheels and a firm parental hand are necessary to stabilize and sometimes even to stop retail investors. But that image is very much at odds with the picture I have after hearing for years now from scores of retail investors who want to participate in private markets. These people are smart, thoughtful, and educated, often self-educated. They understand that investing in private markets comes with unique risks, limited transparency, unpredictable returns, and limitations on liquidity. But they want to have the freedom to invest in the assets in the markets that they choose, and they resent the fact that private markets are the exclusive reserve of the wealthy. Their frustration has only grown with the expansion of the private markets. The committee's consideration of draft recommendations regarding retail investor access to private markets is therefore timely. The draft correctly identifies the need for a, quote, recalibration of the existing regulatory framework, which was designed for a world in which the public markets encompassed the vast majority of all investment opportunities. The draft focuses on securing access to private markets for retail investors through registered funds and recommends that any direct access be accompanied by limitations and enhanced requirements. I appreciate the time and thought that went into the preparation of the draft recommendations, and I look forward to your discussion today as you consider finalizing them. I do have several questions for your consideration during this discussion. One draft recommendation would have the Commission require that funds disclose additional information to retail investors about how portfolio assets are valued. Given recent efforts by the Commission to streamline information to make fund investors more likely to actually engage with the information that they receive, would that disclosure of additional highly technical information regarding valuation be useful to retail investors and funds? Another draft recommendation would have the Commission, quote, work with FINRA and state securities regulators to provide guidelines on when investments in private market assets are in an investor's best interest. Would producing such guidelines be an appropriate role for regulators? Wouldn't it be better to leave determinations of when an investment is in the best interest of a particular investor to the investor and her investment professional who already is subject to Reg BI and or the Investment Advisors Act? With respect to expanding retail investors' access to private assets in direct ways, please think through the consequences of increasing Regulation D offering costs by requiring issuers to adhere to more onerous disclosure requirements. Would issuers be dissuaded from relying on Reg D altogether and move toward 4A2 offerings? Would small issuers raising little money be functionally barred from using Reg D? And finally, the draft cautions against, quote, going from no access to full access to the private markets, and would both place prudential limits on the amount that can be invested by retail investors who do not meet sophistication or wealth criteria, and index the existing income and wealth thresholds for inflation on a going forward basis. Though investment caps are an option that I and others have mentioned in the past, my preferred approach remains full access for all investors to the private markets. Even were my preferred approach to become law, public company investments would likely continue to dominate retail investor portfolios, and most retail investors likely would prefer to invest through registered funds. As I mentioned, however, many retail investors I encounter want the freedom to choose for themselves how much exposure they have to the private markets and how they get that exposure. How are these Americans' interests reflected in your draft recommendation? Thank you so much for your willingness to dedicate so much of your time to this committee, and thank you to Christina and her staff for your work in making this committee work. Thank you.
Thank you, Commissioner Peirce. Next, we'll have Commissioner Crenshaw for opening remarks.
Morning. Thank you, Brian. I I assume you all can hear me.
Yes.
A little weird virtually. All right. Thank you. I also want to start my remarks today with a welcome to the IAC's newest members, Rodney, James, John, and Sergio. Thank you all for accepting your nominations, and thank you in advance for the time and thoughtful engagement that I know you will bring to the committee. Of course, I'd also like to thank the other committee members who have joined us today. And the committee's mandate is more important now than ever. In a word, the commission is busy. We begin to tackle all manner of issues with increasing speed, and it's deeply important that we hear from you, the voice of investors, as we grapple with pivotal policy changes. So today's agenda, as you've heard, covers two topics on which the commission is eager for input: foreign private issuers and retail access to private markets. First, regarding foreign private issuers. The eligibility criteria for and regulatory treatment of foreign private issuers is, of course, a subject on which the Commission recently published our concept release. As you will recall, at the time that we put out the release, I voiced support for a review which was animated by the need for a level playing field between foreign and domestic issuers, and to close loopholes which allow access to our markets without concomitant disclosures or protections. Our regulatory framework should, of course, accommodate foreign private issuers to the extent they are already subject to a comparable, robust regulatory framework in their home country, which would require, for example, substantive disclosure, comparable to what U.S. investors receive from domestic issuers. But foreign private issuers should not be advantaged over U.S. companies in our own markets, nor should our laws offer loopholes to foreign companies or incentives to forum shop. When regulations in this area become too lenient, U.S. companies and investors lose. The concept release addressed some concerning data, for example, that over half of 20F filers trade exclusively in the U.S. and not in their home country or other markets, raising the possibility that these companies are not actually subject to another regulatory framework, a presumption baked into the regulations as they exist today. And as we know from the research of today's panelist, Professor Dan Taylor, other loopholes in our foreign issue regime exist. Professor Taylor wrote a paper demonstrating that certain foreign insiders, especially in the non-extradition countries of Russia and China, appear to engage in opportunistic and potentially abusive trading, lining their pockets to the detriment of U.S. investors, because of regulatory loopholes that we've left open for them under Section 16 of the Exchange Act. We've also heard from others, such as the Council for Institutional Investors, and Jeff Mahoney, I believe, is on the panel today too, about the potential problems posed by an increase in VIEs in our markets. VIEs are legal structures used overwhelmingly by Chinese companies to list on U.S. exchanges, where the company is controlled through contractual arrangements other than direct ownership. These entities pose a number of uncertainties as to the legality of their structure, myriad risks to investors, potential money laundering, and other concerns. In response to this release, we've received 75 comment letters with different potential solutions. So I'm interested to hear from Professor Georgiev and our panel of experts today about whether we are properly regulating foreign private issuers. Have we framed the questions correctly? Have we properly identified the precise problem relating to foreign issuers? Is restructuring the definition of foreign private issuer the right solution? If not, help us pose the right question. And how do we fix the problem in a targeted manner without causing too much disruption to compliant issuers and exchanges? What is a solution that best levels the playing field and provides adequate protections for investors and markets? Thank you, Advice, for your insights and expertise on that panel, and in particular to our colleagues from the FCA for being part of the discussion today. We welcome your considerable insights from your considerable insights that you bring from abroad and bringing them here today. The second item on today's agenda is retail access to private markets. As you know, there's significant interest in this topic from all levels of government and industry, as evidenced by the recent executive order on access to alternative assets in 401k for 401k investors. So your recommendations today are extremely timely. I have deep reverence for the public-private markets divide that is one of the hallmarks of our regulatory landscape. So I appreciate your firm warning to the Commission on the need for guardrails if we do decide to push the boundaries of that divide as they currently exist, particularly with respect to direct retail access. I am concerned, however, about the idea that registered funds are the silver bullet to facilitate greater private market access. Of course, I understand your desire to steer investors toward products with more protections if they're going to have exposure to riskier private markets. But I worry about contorting registered funds into something they are not. Traditional retail funds, including open and closed-end funds, are intended to offer varying degrees of liquidity, but still more liquidity than private market investments. In fact, reliable liquidity is a marquee feature of registered funds. Retail investors can invest with confidence because they know they'll be able to get their money out if they need it. Even retail investors in closed-end funds, which are designed for less liquid investments, have an expectation that their investments are indeed 40 Act products with the associated protections. We should be careful to avoid an outcome where registered funds effectively become private funds disguised in registered fund wrappers. While I remain skeptical about the overall proposition of stuffing an increasing amount of inherently illiquid investments into registered funds, I wholeheartedly agree with some of the committee's other recommendations. Should this commission send us down this path of increased private market access? In particular, I welcome the idea of increased and improved retail fund disclosure of all types. Of course, the valuation incongruity between registered funds, which price daily, and private market investments with significant pricing opacity is hard to reconcile. To that end, the idea of more disclosure about valuation and third-party appraisals, coupled with increased fund director oversight in this area, seems particularly appropriate and necessary. More digestible and accessible risk disclosure and layered disclosure formats whenever possible is also an important point. In addition to those high-level reactions, I want to flag several specific recommendations from the committee that warrant, I believe, more consideration. First, I'm not convinced that co-investment flexibility for open-end funds is consistent with Section 17D and Rule 17D1 under the Investment Company Act. Section 17D and Rule 17D1 are cornerstone protections of the 40 Act. Eroding them for retail investors in open-end funds is perilous. Is it wise to entangle open-end funds with private markets in ways that the 40 Act expressly forbids? The committee's recommendation to allow certain closed-end funds to operate as series funds also caught my attention. Unlike open-end funds, closed-end funds generally file on registration statements that are declared effective by the staff, also known as acceleration. By contrast, open-end funds may file registration statements for a new series of an existing trust that become automatically effective after a certain time frame. While I appreciate the efficiencies of the series structure for open-end funds, there are real downsides to applying that same structure to closed-end funds, particularly where we're already jumping in headfirst to so many other closed-end fund changes. Most importantly, allowing closed-end funds to operate as series fund would remove an important opportunity for staff input via the decision to accelerate filings. So I would urge us to proceed iteratively and slowly if we're going to reinvent or significantly erode the public-private markets divide with these types of changes. This brings me to your recommendation on direct access to the private markets for retail investors. The committee's composition of diverse and divergent voices is one of the things that makes it such a successful and useful body. That is reflected in your recommendation. I understand why the committee ultimately could not come to a recommendation on expanding access to private markets. But understanding that some forms of expanded access may be likely, have put forward some very thoughtful proposed guardrails. In particular, the committee notes that increased access should be paired with increased information. As you point out, Ralston Purina opened the door for certain investors to participate in unregistered offerings because, quote, they have access to the kind of information which registration would disclose, close quote. And in Hill York, the Fifth Circuit expanded, noting that if investors, quote, did not possess the information requisite for a registration statement, they could not bring their sophisticated knowledge of business affairs to bear, close quote, in deciding whether to invest. As you so sensibly observe in the report, sophistication without information is of limited use in navigating the private markets. I agree with the committee that reforms to Regulation D are warranted in light of the spectacular growth of the private markets, and this becomes even more important if expanded access becomes a reality. Investors should be entitled to basic, unbiased material information before they invest in a company, and then an ongoing basis related to their investments. Investors should know about the management, operations, and financial health of a company about which they are considering investment. The information required could be scaled based on the size of the issuance and the issuer, but it must be meaningful and consistent across companies. Your recommendations to make reforms in this area consistent with these principles are worthy of Commission consideration. As you can tell, I'm deeply invested in the work of the committee on these important topics. So thank you again for all that you do on behalf of American investors, and I look forward to our continued engagement.
Thank you, Commissioner Crenshaw. Thank you very much. Next will be Commissioner Ueda. Commissioner Ueda could not join us today in person, but has recorded his opening remarks.
Good morning. Although I'm unable to join you in person, I'd like to extend a warm welcome to the newest members of the Investor Advisory Committee, Rodney Comges, James Copeland, John Gulliver, and Sergio Rodriguera. Thank you for stepping forward to serve. Your time, expertise, and commitment to investor concerns are deeply appreciated, not only by the Commission, but by the millions of investors whose interests you help represent. It is a responsibility that I know you will carry out with the diligence and effort that your predecessors have shown. At today's meeting, the first topic will cover SEC regulatory treatment of foreign private issuers. And I would like to extend a special welcome to our colleagues from the UK Financial Conduct Authority, who are part of that panel. We are pleased to have you join today's meeting and value the opportunity for continued dialogue and cross-border collaboration. I particularly appreciate the appearance of Ashley Alder, whom I first met during a 2015 visit to Hong Kong when Ashley was still in charge of the Securities and Futures Commission. Since then, I've greatly appreciated Ashley's contributions in his roles as IOSCO chairman and now as chairman of the FCA. The second topic will consider a recommendation on calibrating retail investor access to private market assets. This discussion is timely, as regulators are implementing President Trump's executive order to encourage the inclusion of alternative investments as part of 401k retirement plans. The recommendation examines how registered funds may offer a more structured path for retail access, while also addressing the risks and potential safeguards of expanding direct access. Thank you to the many committee members, including former members, who have helped draft that statement over the past year. I look forward to the committee's continued work to inform the Commission's policymaking. Thank you again for your participation today.
Thank you again to our chairman and to the other commissioners. Let's now turn to the first item on our agenda, which is the approval of the minutes from our June 5, 2025 meeting, which has been circulated prior to the meeting. Do I have a motion to approve the minutes?
So moved.
Can I get a second? Second. All those in favor?
Aye.
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 The minutes are approved. Now I'd like to turn to the morning session of our panel, reconsidering the eligibility criteria and regulatory treatment of foreign private issuers, moderated by George Georgiev. Again, before we start, like others before me, I'd like to recognize Chair Ashley Alder, Chair of the Board of the UK Financial Conduct Authority, and Helen Boyd, Director of Market Oversight of the FCA, who are here and a part of our esteemed panel. George?
Thank you, Brian. Welcome, everyone. We have an all-star panel today in two parts focused on foreign private issuers. We'll hear from Chair Alder of the FCA, John Horsfield Bradbury from Sullivan & Cromwell, Dan Taylor from the Wharton School at the University of Pennsylvania, Yulia Guseva from Rutgers Law School, and then Helen Boyd from the FCA in the morning. And then in the afternoon, we have two additional participants, Jeff Mahoney from the Council of Institutional Investors and Paul Dudek from Latham & Watkins. I'll give a brief overview of the ecosystem and the legal landscape surrounding foreign private issuers. So over the past 2 decades, if we look on a very superficial level, it seems like the number of foreign private issuers has remained the same. We had about 950 foreign private issuers registered with the Commission back in 2003. And then at the end of 2023, that was, again, the number. And by the way, here I want to commend the SEC staff on putting together a lot of useful statistics in the concept release, which they released in June of 2025, and many of the statistics that I am citing and trends come from that concept release. So it seems like the number of foreign private issuers is the same, and we may be lured into thinking that the legal landscape hasn't changed. But actually, the legal landscape has changed considerably. So the jurisdiction of incorporation and headquarters, there has been a significant shift away from older traditional jurisdictions, such as Canada, the United Kingdom, Western Europe, and the like. And there are many more offshore incorporated issuers. There's also more of a disconnect between where a company is headquartered and where a company is incorporated. Just to give you some data on this, the fraction of FPIs incorporated in where the jurisdiction of incorporation did not match the headquarters has grown from 7% in 2003 to almost half, 48% in 2023. So issuers are headquartered in one jurisdiction, but they are actually incorporated in a different jurisdiction. There's also been a shift in home country jurisdiction patterns, and there is a big increase in China-based issuers among FPIs, especially those in offshore, incorporated offshore. Interestingly, the trading concentration in U.S. markets has also changed considerably. Equity trading is increasingly concentrated in the U.S. markets, the NASDAQ and the New York Stock Exchange, with the NASDAQ accommodating most foreign private issuers. And about 75% of 20F filing FPIs had more than 50% of their global trade in the U.S. in 2023. Again, one of the biggest takeaways is the mismatch between the jurisdiction of incorporation and the headquarters, and the rise of China-based issuers, which are incorporated in the Caymans or the British Virgin Islands. So with that, I will turn over to Chair Older of the FCA for his opening remarks.
Thanks very much, George. And look, it's great to be here and to participate in this important discussion. I should start off by, I suppose, by saying that we at the FCA are very supportive of the FPI regime. I think for the reasons that Chair Atkins went through at the very beginning of this meeting. There are clear benefits around the facilitation of cross-border capital investment, not only to benefit those companies who are able to access U.S. markets and U.S. investors, but also obviously for U.S. investors to diversify into overseas businesses. But by trading, and I guess this is the point, in those overseas businesses on familiar home U.S. markets, as distinct from overseas markets. And of course, that sort of cross-border capital formation, capital investing, is conducive to economic growth. Economic growth is one of the four main pillars of a strategy that the FCA issued earlier this year, a 5-year strategy. And fundamentally, that is around the relationship between what we do as regulators and the broader context of economic growth. There's a lot there. I won't go into it now, but nevertheless, the question of cross-border investment is relevant to that. Now, the UK and the US are, and have been for some time, the two most successful global capital markets. So how we agree to cooperate and indeed enhance cooperation really matters. It really matters in its own right. It also really matters because that provides a model for others. I think just looking at the concept release itself, which was really informative. Actually, and one statistic I thought that came out, which was interesting, is that the population of companies or issuers that you were referring to are are large in number, but small when it comes to market capitalization as a proportion of the whole market capitalization of foreign private issuers, which it just struck me as quite interesting comment on the shape of this market, effectively. Anyway, well, look, we do obviously understand the need to reassess the balance between, I guess, the privilege of market access for foreign companies and sufficient investor protections, particularly for those investors who are entitled to ensure that home markets provide a high element of safety. Clearly, it is appropriate that when conditions change, there should be an assessment of whether that balance has also changed and whether it's become unnecessarily distorted. I should say here that, just taking a step back, I think from our perspective, whatever solution is arrived at in relation to the problem that's been identified in the paper, that solution should ensure that the foreign private issuer sort of ecosystem remains successful. I think earlier on in some remarks there was kind of the risk that solutions could disincentivize to such an extent that the system is far less successful than it is now in achieving the objectives I mentioned at the beginning. And actually, just again, taking a step back, this discussion for me personally is quite nostalgic in the sense that both in my former position as CEO of the Hong Kong regulator and then chair of IOSCO, we periodically had quite detailed discussions about the opportunities and limits of cross-border capital raising. And phrases such as substituted compliance, deference, mutual recognition, equivalence, et cetera, are all deployed in those conversations. And I think we're not talking directly around those concepts now, but we're still in the same sort of area of which accommodations are appropriate when it comes to assessments of what's happening in relation to the home jurisdictions of the companies that are taking advantage of the system here. So now, we do recognize, I think, that the intent of possible changes are driven by a real concern that the place of incorporation of a company may be different to the de facto corporate headquarters of a company. And that matters, of course, because many investor protections are embedded in the corporate laws of the place of incorporation, as distinct from the place in which a headquarters might be located. And the second point is, I think the big point, as it were, is that if there is no substantive listing or trading outside the US, there is clearly a concern that few or no market standards that derive from the listing itself then exist and then are sufficient to rely on to justify the exemptions and reliefs which exist under the foreign private issuer system. So I'll come to our view on this from a UK perspective. The first point, I think, which comes through very, very strongly in the concept release is that, stepping away from the detail, the underlying question is, and which is inherent in the FPI concept, is justified evidenced reliance on the characteristics and credibility of home market regulation. That's what it all comes down to, effectively. We think that, and it sits in the concept release as an alternative proposal or possible proposal, is that the best way of approaching this, though it is not without resource implications, which are also referred to, is to qualify a company as an FPI through reliance on domestic rules following an assessment of those rules. As an alternative to the bright line eligibility criteria that exist now, and in the concept release there are suggestions about how they may change. And just to be clear, as an alternative to those eligibility criteria, we do think that jurisdictions that have signed up to the IOSCO MMOU, which is fundamentally around exchange of enforcement information, is a sensible additional qualification, not least because if we go down the track of an assessment of domestic rules, a direct assessment of domestic rules, information exchange, both at the time of assessment and thereafter, is important for the credibility of that exercise. Now, our concern with some of the proposals around revised eligibility criteria is that they could cut out some UK companies that frankly sit in a jurisdiction, as in the UK, which is undoubtedly one in which investors can place a great deal of trust as a credible jurisdiction for an FPI to originate from. And those go to, I've seen, there are suggestions around the 50% test. There are suggestions around ownership and business contacts and overseas trading volume. And I think I saw the number 95% somewhere, which seemed quite a lot, but nevertheless. So the broader point here, I think, is that not only could they cut out potentially or disqualify, as it were, companies, some companies, if a company was then faced with a radically different set of tests, then there's a whole question about how it reorganizes its business. And would that level of reorganization, when it comes to particularly the business contact tests, just be too great in the view of that company in order to stay within the system, within the FPI system? Broadly, however, we're okay with the concept of there being a listing on a major foreign exchange. And I guess you'd understand why, because London, major capital market, along with the United States, and we host a very major foreign exchange, certainly when it comes to equities, but other venues as well. Just a comment on some of the rationale around the tests here. I think what I took from the concept release when I read it for the second time was that some of the tests that are referred to seem to me to be pretty rough proxies and not necessarily reliable proxies for a sufficient level of home market investor protections. So, for example, if there is a foreign volume trading requirement, does that actually correlate to a reliable set of investor protections, disclosure requirements, and such like that would then operate in the way which you might expect? Other tests seem to be aimed at defining what is and what is not foreign, effectively. So the business contacts tests are a bit like that. And I do wonder the extent to which both of those, the rough proxies around jurisdictions that seem to offer sufficient investor protection, the firm volume trading requirement, for example, if that goes ahead, or the what is foreign test, do they really get to the heart of the matter? That's why, in large part, I think that only an assessment of the rules and expectations that exist in home jurisdiction, really, that gets to the heart of the matter in practice. There's a question around place of incorporation and whether it should be the same as as the headquarters of where a company's headquarters. I think that's an open question, and I think it probably requires a bit of thought and debate, but it's certainly something I think which is a credible question to ask, or the right question to ask. Just getting to the question of assessments, and I referred earlier on to subject to compliance and deference and such like. The concept release, absolutely right. It focuses on the potential downside of that, which is just the resources that any organization would need to put in place in order to conduct that sort of assessment. And I think actually, if we go down our recommended path, which is that as an alternative to the other sort of bright line tests, I think it would be useful to put some work into how to streamline that process, particularly if it is regarded as a potentially reciprocal process. So I'll end there and pass on the baton, but happy to answer any questions in the Q&A later on. Thank you.
Thank you, Chair Alder, for these illuminating perspectives. We'll now turn to John Horsfield Bradbury from Sullivan & Cromwell.
Thanks, George, and thanks, Chair Alder, for your remarks. George asked that I outline the issuer perspective to this concept release. I've been a partner at Sullivan & Cromwell for around 10 years. Sullivan & Cromwell has represented foreign issuers accessing the US capital markets for decades, probably nearly 100 years. I should explain, although I'm an English person with an English accent, as seems to be the case on this side of the table, I'm not an English lawyer. I went to law school in the US, and I've always practiced in London representing foreign private issuers, in many cases, on accessing the US markets. As part of this exercise, obviously many of our clients and many other foreign companies are very interested in this concept release, and we've spoken to many issuers from, I think, nearly 20 jurisdictions listed in multiple venues across Europe, as well as some that are only listed in the United States. So we've spoken to some dual-listed companies that have been listed in one case in England and the US for over 50 years. We've spoken to some single-listed companies that are only listed in the US, even though they're headquartered and incorporated outside the US. And we've spoken to companies that are excited about the prospects of listing in the US in the future, and hoping that whatever changes come about here do not reduce their likelihood of being able to do so. I'm conscious that this is the Investor Advisory Committee, and so even though I'm presenting the views of issuers, I hope that I will sort of demonstrate that the current FPI regime is working in many respects well and has done for decades for investors, drawing world-class issuers to the US markets without really any significant demonstrated investor protection failures. I think the point that Chair Alder made about any possible changes, and Chair Atkins indeed, any possible changes having an impact in driving listings away from the US is a significant one. It's worth remembering perhaps over the course of history that in around 1996, the US represented 45% of global IPOs, whereas in the period around 2006, it dropped to around 20%. Of course, there were significant regulatory changes in the United States, and they were driven by investor and market demands, and they made sense, of course, at the time. But it is critical to note that any changes could have a significant disincentive. From personal experience, I've worked with a number of issuers where the decision as to whether to either list primarily in the US, in the context of whether to list in the United States together with a dual listing abroad, or only list abroad, or indeed only list in the US, has been a close decision. And so any changes here could move the needle in terms of the potential for issuers being interested to invest. So maybe I'll spend a few minutes on how we see the sort of benefits to US investors of allowing FPIs to list under the current regime. US investors, obviously through the FPI regime, have access to global issuers while benefiting from significant US protections. It's worth saying that no issuer lists in the US and takes that decision lightly or thinks it's an easy ride. Every issuer, foreign private issuers included, are subject to the US securities laws. And when we're briefing issuers on the consequences of listing in the US, they take very seriously, and we probably spend more time on the consequences of US securities laws than they do on specific disclosure requirements in some cases. No one thinks it is an easy ride. And of course, US investors being able to invest in foreign issuers that are listed in the US benefit from those securities law protections, whereas they would not if they were investing internationally, as of course they're able to do so in today's markets. US investors also benefit from a robust baseline of reporting. Of course, foreign private issuers file Form 20F rather than Form 10K, and if you look at the forms in the book, as I did when I was a junior lawyer, they look very different. But actually, I would say 95% of the disclosures that a foreign private issuer makes on Form 20F are identical to the disclosures that are made on Form 10K. Critical areas including risk factors, business description, the management discussion and analysis of financial results all follow the same requirements and principles. Financials, of course, may be IFRS instead of US GAAP, but they are subject to PCAOB audit. The CEO and CFO provide Sarbanes-Oxley certifications. Disclosure controls and procedures and internal control over financial reporting both apply. So that's with respect to the annual report. Of course, NYSE and NASDAQ listing rules require semi-annual financial statements, and so all US listed issues provide those. One of the topics in the release is Form 6K. Of course, it seems like, especially for what we refer to as the exclusively US listed issuers that don't have a listing outside the US, they seem to fall into a bit of a gap with respect to Form 6K, as Form 6K is only required when there is a filing requirement outside of the United States. If we think about dual listed issuers for a moment, then of course they file a Form 6K when they're required to by their home country listing. In many cases, including in the UK as a result of the market abuse regulation and across Europe as well, the requirement to file immediate disclosures may be more onerous, is more onerous in Europe than it is in the US, because of course a domestic US issuer is only required to file a Form 8K if it falls into one of the listed criteria on Form 8K, whereas any material disclosure is immediately publishable in Europe. But even if you look at the exclusively US issuers, the single listed foreign issuers in the United States, there is an analysis that they file a number of 6Ks that is very similar to the number of 8Ks the domestic filer makes. On average, a domestic filer makes around 15 8K or 10Q filings each year, whereas a single listed foreign private issuer only listed in the US makes around 13 6K filings. So it's not the case that foreign issuers that are only listed in the US are only filing their annual report and their semi-annual financials and making no announcements to investors in the meantime. You might wonder why this is. Well, it's because the market demands it. You know, many of those foreign issuers will file quarterly results, even if they have no obligation to do so in their home market or in the United States, of course, as a foreign issuer. And they also will update the market on material developments because either they need to from a potential liability perspective or because their shareholders in the market otherwise demand it. One other topic is Section 16. If foreign private issuers are not subject to Section 16. Well, again, if we think about dual-listed issuers, in many non-US jurisdictions, there are mandatory reporting obligations that are analogous to the Section 16A reporting requirements. For example, the market abuse regulation in the EU and its UK equivalent require the disclosures of trades by persons discharging management responsibility, which is a very similar definition to the universe of executive officers in the United States. US companies that are exclusively listed in the United States may not have such an obligation, but now that Form 144 is subject to prompt mandatory electronic filing, there is, of course, real-time visibility on insider sales. And so, in fact, for US exclusive foreign private issuers, there may be more disclosure now of immediate trading than dual listed in the United States because, of course, issuers that are only listed in the US, their insiders will be required to sell in the United States, whereas foreign issuers, their executives may sell under Regulation S and so not be subject to filing a Form 144. So why do foreign companies list in the US in the first place? The concept release implies in places perhaps that companies are taking advantage of the foreign private issuer exemptions to fit within a loophole. That's not our experience. Companies list in the US because they want to take advantage of deep liquidity in the US, the high valuations, and the better analyst coverage that comes in the US markets. It's not cheap listing in the United States, and as I say, those securities law considerations are significant. So when companies are making the decision to list in the US, it's because they believe it is the best place to raise capital and to have the best liquidity in their shares. One potential consequence of rule changes could be to incentivize an issuer to set up a listing in its home country, depending on some of the potential solutions that have been proposed. I work with issuers from small markets. It may be possible for them to list in their home market, but doing so could impose significant costs on the listing process, and splitting the listings in that way may not make sense from a liquidity perspective. Also, listing venues outside the US may impose significantly onerous disclosure requirements that go beyond US requirements. For example, in the sustainability area now in Europe, I think issuers are focused on disclosures being more significant and onerous in Europe than they are in the US. One of the significant draws to the US at the moment is, of course, that there is less likelihood of there being significant disclosures obligations in new areas like that. And so if the SEC was to indirectly require such an obligation, it may disincentivize listing altogether. I'm going to spend a couple of minutes on who today's FPIs are. I think this is a really important point, as Chair Alder referred to. If we look at the concept release had very helpful breakdown, as George referenced. I think updated to today, there are around 1,000 20F filers with around an 11 trillion market capitalization. If you take the top 100 by market capitalization, that's companies with a market capitalization of $20 million or more, that represents 9.5 billion of market capitalization. So that's 10% of the issuers by volume, representing 85% of the market capitalization. Now, I'm going to read out a few numbers here. I will try to do this quickly, but I think it is helpful to understand who these 100 companies are. 27 of them are incorporated in the EU, Switzerland, or Norway, so in the European Economic Area, which shares a regulatory regime. Their market capitalization is around $2.5 trillion. Around 19 are incorporated in the UK. They have a market capitalization of $2 trillion. And then if we take Japan and Taiwan, because they also have very large companies, there are 12 incorporated with an aggregate market capitalization of 2.4 trillion. So that's 70 issuers, and together they have a market capitalization of over 7 trillion. So that's 7% of the issuers with nearly 2/3 of the market capitalization. 66 of those 70 companies are dual listed, so they're listed in their home country and subject to rigorous oversight in their home jurisdictions. In many cases, they are literally the largest companies in their home jurisdiction, and their home regulators are strongly incentivized to regulate them. So that was the EU, the UK, Japan, and Taiwan. It's worth saying out of the rest of those 100 companies, there are many dual-listed issuers from Brazil, India, Australia, and Mexico, all subject to oversight in their home country. Of the 100, there are only 12 that are exclusively listed in the US. 4 of those are incorporated and headquartered in Europe, or the UK. 1 is in Israel, 3 are headquartered in Singapore, and only 3 are based in China. So the SEC concept release highlights the changing nature of the FPI population, and there are a lot of statistics about 50% of listings being China-based issuers. And the absolute number of registrants has certainly changed the composition in recent years. But we must keep in mind that if we adjust on a market cap adjusted basis, the traditional jurisdictions still play a very significant part. The concept release focuses on those companies that are listed exclusively in the US. And I think there are around 520 in the concept release. 360 of those were incorporated in the Cayman, BVI, Marshall Islands, or Bermuda. And the release notes the potential for less oversight in these jurisdictions. Of the other countries, there are a significant number of issuers that are incorporated in Israel, and then a number of other jurisdictions that have sort of less than 10 issuers each. And now I'm talking about all issuers, not just the largest 100. This is the sort of universe of 1,000. Israel is a particularly interesting case, and there are a number of very interesting comment letters on behalf of Israeli companies and Israeli market participants, which I strongly encourage the committee to read. those letters focus strongly on the special regulatory environment which Israel has developed, which, even if it does not require a home country listing, imposes significant corporate law and corporate governance obligations on Israeli companies that are only listed in the US. I have also not seen really any academic or other scholarship indicating that there are any concerns with respect to companies that are incorporated in Israel. And so that is an example where, for example, if the SEC was to introduce a requirement for a foreign listing or a certain trading volume outside the United States, that it could have consequences for that regulatory regime, where there have been significant benefits to Israeli companies and US investors, on investors being able to invest into them. If we take some of the cases in Europe that are only listed in the United States, there are some very large companies that are incorporated in the UK, Luxembourg, and the Netherlands. Each of those companies provides very fulsome disclosures to the market, and again, some of those issuers have provided letters directly in response to the concept release. Those issuers argue it would not make sense to require them in some way to have a foreign listing, and that the market does not, and they do not think the market expects it. And I would encourage the committee to read those responses as well. So the large number of Cayman, BVI, Marshall, and Bermuda companies represents a small amount, I think between 1% and 2% of the market capitalization of foreign companies. Much of the concept release highlights concerns with these entities, but we must focus on the fact that any changes made to the regime as a whole could have unintended consequences on other companies that represent much more significant volume of the market. I'm going to spend a couple of minutes on the proposed, the suggestions for changes in the release and the challenges that come with them. One area for comment was modifying the existing FPI definition, including the current 50% threshold for US ownership. The challenge here is that issuers don't control their US beneficial ownership. A large number of foreign private issuers today have a significant US shareholder base. It could be around 30 or 40%. They monitor it over time. There are some issuers that are required to keep their foreign ownership below 50%, and they have means of doing so. But if that percentage was changed, it could have a cliff edge effect on issuers who for years and decades have monitored their share ownership such that it remains below 50%. Another area is foreign trading volume. There are two thoughts to response here. If a company is US exclusively listed, then of course none of those companies by definition could satisfy the test. I've already talked about the Israeli companies and the large UK, Dutch and Luxembourg companies that would fall foul of any such test. Then of course there are dual listed companies. Those companies have significant listings in their home jurisdictions, but it is worth keeping in mind that the depth of the US capital markets are such that even a company which is the largest company in Denmark, for example, could easily have trading volumes in the United States that are higher than in its home country, just based on the depth of the US capital markets. It's also the case that the issuer has no control really over where the trading volume is. And for example, if a stock becomes a meme stock in the United States, it may be subject to very high trading volumes over a period of time, but it would be irrational for that to mean that it lost foreign private issuer status if for 1 year it had particularly high trading volume in the United States. Some of the concepts that Chair Alder referred to are very interesting, where the SEC is required to make some assessment of foreign jurisdictions. A number of my clients, including my UK-based clients, who I think are probably relatively comfortable that they would be on the good people list, are fine with that approach. The challenge there is, of course, that there are over 60 jurisdictions from which foreign private issuers are listed in the US, and maybe not quite that many, but tens of trading venues. And so the challenge is for the SEC to be able to make assessments of those jurisdictions. And of course, those jurisdictions do not stand still in terms of their regulatory regime. In my experience, whenever there is a good jurisdiction list, there will be a flight to whichever the jurisdiction that is the least good, or perhaps the bottom of the list in terms of what the obligations are. And those kinds of incentives are always challenging. Some other commentators suggested a blacklist approach rather than a whitelist approach. which is interesting. But again, it is challenging as to where the SEC would draw the line in terms of preparing those lists. I'm just going to spend a couple of minutes now on the accommodations that apply to foreign private issuers, and which ones and the significance of them. Of course, US GAAP financials as compared to IFRS financials is a critical area. Many issuers are required to report under IFRS, and so if they were required to report under US GAAP or reconcile to US GAAP, that would be very burdensome for them to do so. The introduction from the SEC in 2007 of allowing IFRS financials was very significant in terms of sort of reopening the US capital markets to foreign issuers. Section 16 reporting adds cost and complexity. As noted above, dual-listed companies are subject to similar requirements in their home markets in many cases, and it would be very inefficient to introduce overlapping requirements. And of course, single-listed issuers are now subject to electronic Form 144. 8-KIE style reporting, again, most foreign issuers by market cap are subject to requirements in their home country. And introducing 8K for them as well would have overlapping requirements. And the US proxy machinery is key to US state law. There are already foreign incorporated companies that are domestic filers with whom we work and are subject to both their home country requirements and the US proxy rules. And it is very complicated, and there are some jurisdictions where it would be very challenging for them to work together. The final point I'll make is one of potential collateral consequences. Quite a lot of the technical law firm letters spent quite a lot of time on this. I don't actually think it was what the SEC envisaged in the concept release, so I won't spend much time on it. But it's very important to note that the foreign private issuer term is used in many areas other than what we've really discussed today, which is sort of the consequences of having an equity listing and what exemptions you're able to take advantage of. Rule 12G32B under the Exchange Act, Regulation S, the deregistration requirements, the tender offer rules, they all reference foreign private issuers in some way. And should the SEC make any changes, it should look very carefully about whether the changes make any sense in the context of those rules. So with that, I will summarize by saying that, from my perspective, there is no current market failure that needs to be solved here. To the extent there are challenges, they represent, probably 1% of the universe of current foreign private issuers. Existing disclosure requirements are significant, and there are valid reasons for foreign issuers to want to list only in the United States. That's due to the attractiveness of the US capital markets. It's not because of some regulatory arbitrage that these companies are taking. And so with that, I'll conclude my remarks. I'm, of course, happy to take questions.
Thanks so much for this, John. So we're turning now from the regulatory and practitioner perspective to the academic perspective, and we have two professors, Professor Dan Taylor and Professor Yulia Guseva. They've both spent many, many years conducting very rigorous research in this space. And so with that, I turn it over to Professor Taylor.
Thank you to the committee members for inviting me and to the commissioners for starting this whole process of looking at the foreign private issuer disclosure regime. So I'm titled my talk is on the slide deck. I've got a considerable slide deck. I'm going to try and breeze through it within, say, 15, 20 minutes. I know it's long, and I appreciate you guys sitting still for this entire time. I wrote a paper called Holding Foreign Insiders Accountable. And that's going to feature prominently. George asked it to feature prominently. But what I want to do is I want to level set. So my role here is I'm going to make some recommendations in the end, but I don't think they're going to be controversial, although maybe they might be. I mainly want to do an educational presentation. So I inform, and you guys decide what you want to do. And that's also my view on what my role is towards the commission. So about me. Ironically, I am the Arthur Anderson Professor at Wharton, and I specialize in fraud hunting using data analytics to detect and deter fraud and insider trading. I teach classes on that at Wharton, and I run a Wharton Forensic Analytics Lab that specializes in studying market manipulation, insider trading, and white-collar crime in financial markets. I have many grad students and faculty and undergrads. And on that website, very proudly, I have my deck and my presentation from this committee 5 years ago in 2020 and 2021. I don't think anyone on this committee was around then. Like Chair Atkins, I am happy to be before the IAC again and in person this time. I was never given the opportunity because of COVID to be in person. And as a result of that and the IAC recommendations, there were 2 new SEC rules proposed, and I'm really, really proud of that. And Jonathan touched on that, one of which was the electronic filing of Form 144. We're going to come back to that in my presentation. And the other is the amendments to 10b5-1 plans. Now, I want to point out, because I'm very proud of this record, and I think we might have an opportunity for something here again. Both of those were 5-0 bipartisan votes. Show of hands, how many people know of any other bipartisan 5-0 votes? All right, I think we might have an opportunity here again for a bipartisan vote. So some education. Let's begin with the current topic. All right, as Chair Atkins noted, foreign private issuer regime introduced in 1983. Original logic, make U.S. exchanges great the first time. You know, international companies listed in the U.S., you know, no disrespect to my London friends, not London, not Nikkei, help facilitate U.S. financial dominance. Good news, Wall Street won. We are in a very different market since then. And so I have a plot, might be hard to see, might have to squint. As of 2022, 12 trillion in foreign private issuers, and it's pretty much a 30-degree upward trend since that time. Key exemptions. This was new to me. In fact, many people, when I tell them the exemptions, they don't believe me. So we just want to touch on these just so we can all level set. The first one, and we'll get into these in detail, foreign private issuers, and I'm going to repeat this, are not subject to U.S. SEC materiality standards. And I'm going to pull from, if you're squinting, you're like, what? I'm going to pull from material actually written by one of our guests after lunch, Paul Dudek for Latham Watkins. But that is actually true. And there are no filing deadlines to report material events. The SEC for U.S. issuers says, hey, you have to report an 8K on this type within 2 days, cybersecurity within 4 days, or whatever it is. Not so for our foreign private issuer friends. Not subject to Reg FD. Now, many people I talk to are like, what's Reg FD? Reg FD is Reg Fair Disclosure. Reg Fair Disclosure says, if I'm a company, I can't tell the analysts, hey, it's looking great this quarter, this is what our earnings number is going to be, without putting out an 8K. But if you don't have Reg FD, you're actually allowed to selectively disclose MNPI, not only to investors, but to analysts. I presented this paper actually at Harvard Law, and, you know, one of the students there, sorry to say, was like, oh yeah, Alibaba does this all the time. They have a call for select analysts afterwards where they give the earnings projections. 3, not subject to Section 16 of the Securities Act. What's Section 16? Form 4 filing. U.S. insiders have to report their trades, buys and sells of all securities within 2 days, company securities, all company securities within 2 days on Form 4 to the public. And finally, you know, with respect to some of the opinions here, some foreign private issuers are not subject to meaningful enforcement and therefore not effectively subject to U.S. securities laws. In fact, there's papers out of Harvard calling certain jurisdictions law-proof. So let's get into this. Not subject to U.S. SEC materiality standards. So here's a paper by Audra Boone, Catherine Schumann Foster, and Josh White. Catherine was at the U.S. SEC at the time, and Josh White was at the SEC. He's now the acting chief economist at the PCAOB, so he knows what he's talking about. The SEC defers to home country regulators for what constitutes a reportable material event, and you heard that in some of the talks. So, for example, if China says that you don't have to report when the CFO resigns, that does not trigger a reportable event under current FPI guidelines. Yeah, they could voluntarily do it if they wanted to, maybe put out a press release and therefore then put out a 6K. Companies in disclosure havens report less. So it's not the case that everyone's reporting the same as US 8Ks. That would just, like, why do we think they're in China and Caymans in the first place? Companies in disclosure havens report less, but when they do, boy, markets move, all right? So there's not this investor demand driving voluntary disclosure. Companies appear to be some foreign companies appear to be withholding the disclosure. This is from the Latham Watkins note that we'll hear more about from Paul Dudek, basically saying, hey, there's no fixed deadline as long as the Form 6K is disclosed promptly. Now look, I hunt fraud. So some people say, oh, reporting flexibility is good. That's great. Reporting flexibility can also be abused. And home country rules determine materiality thresholds. Not subject to Reg FD, we talked about this. Right, again, Paul Dudek basically, his work at Latham Watkins saying, hey, they're exempt from Reg FD, most voluntarily comply. This isn't a story about most, okay? You know, this is a story about picking up the bad apples and maybe thinking about some disclosure regulation or some changes to the FPI regime to sort out the bad apples from the good apples, all right? All right, not subject to Section 16. This is you're going to have to bear with me. We're going to go down a little bit of rabbit hole of this. And I have to tell you, the first time I actually told an SEC commissioner of the findings, they didn't believe me, and I had to actually go to the SEC reading room and show them one of the paper forms. Section 16 reporting is what U.S. officers and directors file their trades on, a Form 4. Okay, got to do it within 2 days on EDGAR. I just want to point out, because disclosure burdens came up. You can barely see it, but in that top right corner, every SEC form has the expected disclosure burden. If you can work out what that is, it's 0.5 hours. That's 30 minutes. That's what the SEC estimates this disclosure burden is, to report purchases and sales. It's the single most popular form by downloads from EDGAR. Why is that? You don't need a PhD from Stanford to understand that when the CEO buys, it's probably a good sign. And when the CEO sells, it's a bad sign. So this is simple. It's not IFRS, it's not GAAP, it's not quarterly reporting, none of that. It's just report the trades. Everybody wants to see them. Here's the reading room. You guys can go visit it if you want. There is my team looking at these Form 144s. Now, John mentioned these Form 144s. They were filed on paper, and they got eventually digitized. The Form 144 covers the sale of unregistered securities only. It does not cover registered securities, so pre-IPO shares, for example, and it certainly doesn't cover purchases. It is not correct to say that all sales are covered on Form 144 by a landslide. Most shares are not unregistered. Most shares are, in fact, registered. They don't have to report registered shares. Okay, so what did we do? Here's my example. There's Bob Iger filling out his Form 144 by hand for Walt Disney in 2018. We digitized that. This is Alibaba's form. We went through and we compared them. Now, this is where I get to, poke fun at academics, right? Like, let's recap. Okay, so we're exempt from materiality rules, we're exempt from Reg FD of sharing MNPI, and we're exempt from reporting of stock trades. What do we expect to find comparing our foreign friends to our US friends? Well, some jurisdictions, like the UK, are great. You know which ones aren't? The ones where they don't have to extradite their folks. Here is total stock sales from 2016 to 2021 by country. It's colored red, China, more than 50%. Not only are they selling more in aggregate than everyone else combined, the actual average stock sale is 16 million as compared to 3 million for the US. Looking at returns afterward, the blue line is US. SEC seems to be doing a good job. After a US stock sale by US insider, returns do not go down. They do not appear to trade in advance of negative events. Are non-extradition foreign companies? Yes. it goes down, and it goes down large over the next 12 months. That's our red line. All right? And again, our foreign on average is the gray line. So this is not a problem with all jurisdictions. Here it is by country. My students always mix up the mean and the median, so I just want to lay this out. The median is the 50th percentile. That means 50% of observations when an executive of a US-listed China company sells, 50% of the time, the return over the next 12 months is larger, negative, than negative 23. Notice the two largest countries there? That's the Chinese flag and the Russian flag, both non-extradition. Number 3, Cayman. Couldn't pierce some Cayman entities? Pretty sure I could move some of that gray into the China bin. Statistical tests, 10 billion. So if you took the dollar value of trades, only restricted stock, multiplied it by loss avoidance, 10 billion out the window, vaporized, that the insiders were able to avoid and claim. Why is this happening? Not subject to meaningful enforcement. Here's 2 articles in a Wall Street Journal op-ed by Jesse Fried, securities law professor at Harvard. It's really difficult to investigate insider trading by Chinese insiders or investigate accounting fraud. Why? Where are the records? They're in China, right? Where are the brokers? In China. Right? It gets even worse when you consider private litigation. So if the regulators can't get to it, maybe private plaintiffs can. No, they cannot, because the U.S. delegates to foreign disclosure regimes. So in this particular case, if you Google that op-ed, Professor Fried goes through example after example of how Chinese companies have basically done squeeze-outs of U.S. investors. Perhaps as a consequence, we've seen an increase in IPOs from China. I just want to highlight that number on the right, our far right axis. That's 25% of IPOs coming from China. 25%. Now, there's definitely this idea that we should make IPOs great again. I think I heard that from this commission. Whose IPOs should we be making great again? All right? And it's a market cap of $1 trillion. Now, let's connect the dots. Exempt from materiality, exempt from sharing MMPI, Reg FD, exempt from reporting stock trades, difficult for enforcement. We have a China problem. Right? There's a lot of dancing around, beating around the bush. I understand, UK wants to keep the regime, maybe make some tweaks to it. There need to be wholesale changes to how we address China. And with respect, the FPI regime has failed miserably at protecting U.S. investors in Chinese companies. Rampant market manipulation. Let's go through. Here's all Chinese IPOs from 2011 to 2020. Half of them within 1 year lost more than a third of their value. 3 years after, half lost more than 2/3 of their value. Again, medians. If you're interested, you Google China Hustle. It's a documentary about fraud in China. Most recent data. I always got to like to update. Is it still happening? Q1 2024 to Q1 2025. 48 Chinese IPOs. This data comes from the U.S. government. 64% of them, 31 of 48. Remember, they've IPO'd in the past year and a half, have already crashed more than 50%. 50th percentile again, that's half, negative 70% return. These things are toxic, right? Who does that serve exactly? I would submit it does not serve U.S. investors. A website was actually created, stopnasdaqchinafraud.com. Go to the website. It allows retail investors to post images that they get from their phone, from WhatsApp, from email about people trying to pump Chinese stocks. Now, let's talk about investor protection. There are hundreds of instances in which there are catastrophic one-day declines of 70% or more. That's the hallmark of a pump and dump. We're not talking about like a 10% return from when you miss earnings. We're talking about catastrophic 70%, 90% stock drops. No material events disclosed. Zero. There aren't 6Ks on these dates. Those are single-day returns. More? More? So, yes, the FPI regime has failed investor protection for Chinese entities listed in the U.S. Now, some of you might be thinking, oh, these are like small penny stocks, you know, what have you. I wish that was the case. Here's an example, Regenicell, 82,000% stock pop. Man, I should have had some of that. You know, Vaporize, 33 billion collapsed in days. 33 billion is not a penny stock. All right, evidence-based recommendations. DOJ and SEC are taking action on the enforcement frontier. NASDAQ's increasing its market cap requirements for China listings. I would submit that we need to complement these with efforts for new disclosure requirements for certain FPIs. Now, will disclosure help? They're actually law-proof. Uh-oh. Did we lose the presentation?
They're working on some technical issues in the room.
Okay. Should I stop or should I keep going?
I say let it ride.
Let it ride. All right. All right. So they're law-proof. Professor, you just said they're law-proof. So, like, if I make a report Form 4s or something like that, they're just going to say no. Well, think about what happens then. If companies don't comply with disclosure requirements, that actually makes enforcement cases easier because then there's a scheme. There's something additional that you can charge with. We may not be able to investigate or to trace the money back through China, but we can say you should have reported on this form and you didn't. Noncompliance can lead to delisting. And the final point is very important. Intermediaries are often involved in the filing of these forms. If you have ever opened a brokerage account, they ask you, are you a Section 16 insider, public officer, 10% holder? Why are they doing that? Because they have obligations under U.S. securities law. If we impose Form 4 reporting on these companies, their brokers will have obligations to ensure that they comply. All right. Let's move to some recommendations or maybe some philosophical thoughts. Three-part mission, everybody's hopefully familiar with this. Protect investors, maintain fair, orderly, efficient markets, facilitate capital formation. What is this in the FPI context? I would submit, I'm sure we could disagree, have a philosophical debate, you know, to protect U.S. investors, right? Mission of a U.S. government entity is not to protect foreign investors. Maintain fair, orderly, and efficient U.S. markets. If there's an action that this regulator can take that increases the efficiency or helps U.S. investors, but harms foreign markets, not really sure that considering foreign markets is inside the SEC's purview, assuming we can make a ceteris paribus statement. Obviously, we don't want anything to happen to U.S. markets or U.S. investors. Now, typically we think of facilitate capital formation, we think of compliance burdens, we think of raising capital. You know, I generally agree with that for U.S. companies, but I don't think, I could be wrong, somebody feel free to disagree, that the mission of the SEC is to facilitate Alibaba raising capital on U.S. exchanges, unless we think it has a benefit to U.S. investors, which maybe it does. But I think I've demonstrated that there are plenty of companies out there where they raise capital in U.S. investors or U.S. markets and they don't benefit U.S. investors. So we have to put U.S. first. Again, evaluate everything through the lens of U.S. investors and U.S. market participants. If we can protect U.S. investors, give them all the same choices, but it's going to come at higher compliance costs for foreign companies, you know, that's okay with me. You know, it may not be okay with, you know, them or their counsel, but, for me, it's okay. Okay, recommendations. 1, mimic 8K disclosure requirements. Snap those into place. Snap into place filing deadlines. Same as 8K. Apply Reg FD. This is going to be a heavy lift because there's some cultural differences here. Apply Section 16 reporting requirements. It's the #1 most highly downloaded form. It takes 30 minutes to fill it out. And I should mention, it is bipartisan. There was a bill introduced in the Senate holding foreign insiders accountable, and a bill introduced in the House holding insiders accountable. Brad Sherman, Representative Lukemeyer, and in the Senate, Kennedy and Van Hollen. Bipartisan. Thank you very much for your time. I hope it's proved educational.
Thank you, Dan. That was a lot of food for thought. So now I turn to Professor Yulia Guseva.
Oh, thank you, George, and thank you to the committee for inviting me here. It's a pleasure and a privilege to be here. So it's a tall order to follow this presentation, right? But let me just say that I think the concept release is very comprehensive, but similarly, so scholarship on FPIs. And already years ago, it was clear that more FPIs were coming from the BVI, from the Caymans, and had complex ownership structures. Alibaba went public on the New York Stock Exchange back in 2014. So the trends are not new, and there are years of data. And to be honest, as Commissioner Ujeda pointed out, show me the market failure. Where is the market failure? And to that, I would like to add, where is a clear regulatory failure? I think on balance, the SEC has done a pretty good job. And if we say that Russia and China are corrupt, how is that even news? So if their IPOs crash, well, NASDAQ, and they submitted a comment, is already taking care of that, specifically with respect to Chinese companies. In the United States, as opposed to many other jurisdictions on this planet, we have very strong SROs, self-regulatory organizations. So maybe SROs would require more in those IPOs, as NASDAQ is proposing, and the New York Stock Exchange will probably do the same. Regulation of D, well, it's an easy fix, just one line. Let's add foreign private issuers. It's not even a big deal, as opposed to what the concept release is suggesting in general, a major reform. And I think more data is needed to establish whether such major changes are needed, because I'm not sure that the composition of FPIs actually indicates a huge problem that cannot be fixed with little tweaks. The concept release is also limited in its scope and mainly provides descriptive statistics. It's thorough, but it's descriptive. But what if the market already discounts the securities of the FPIs that report less information? US markets are efficient. They're deep, they're liquid, they're efficient. An objectively reasonable investor, or the aggregate market as such, should price in the discount for the securities from China or from offshore jurisdictions. If so, then the current regime actually would let the investors to diversify their portfolios, which is always good. We cannot forget about the benefits of portfolio diversification in reducing the or averaging out the risks of the investors. They would get access to international assets, and simultaneously, they would account for the risk of individual FPIs by discounting the prices. So I think to date, at least, in the concept release, which is, again, very thorough, the SEC has not provided the data on whether FPI shares, including the shares of exclusively US-traded firms or firms from certain countries, are more volatile, for example, than the shares of similarly situated firms. What are the beta for those securities? What is their cost of capital, abnormal returns, other results? I think a thorough analysis is needed because the potential changes are massive. And as John mentioned, and I think Clifford Chance provided a whole appendix of regulations, dozens of regulations would be affected by the proposed changes. So it's not just about the information asymmetry and reporting. It's also about the market structure, broker-dealers, tender offers, and many others. So without more data or blatant abuses of the existing regime, let's forget for a second about China and Russia, let's take care of them separately. It is unclear what the problem is. Not surprisingly, actually, Most commentators, including not only law firms, but also the National Association of Manufacturers, American Association of Manufacturers, the New York Stock Exchange, and NASDAQ, emphasized that the current regime works well through a combination of market structure safeguards, investor demand, and SRO regulation. And our exchanges, like the New York Stock Exchange or NASDAQ, they do require additional reports. So yes, not 8Ks, but 6Ks in many cases fall under the material disclosures of time and timely reporting requirements for major events. It is already there. And it's in the listing manual, company manual of the exchanges. So if the SEC thinks that those parts of the listing company manual should be enforced more by the SROs, well, that's an easy tweak again. The second factor is investor expectations. Issuers and many law firms indicate that voluntarily disclose information to the market, lest the market assumes the worst and heavily discounts their shares and naturally increases their cost of capital. This is in line with that old line of scholarship dating back to the 80s, Easterbrook and Fischel. And at the same time, it's very, it comports with the prevailing practices in international private placements, and as I mentioned, with the experience of law firm commentators. In short, when investors expect information, issuers usually oblige. To a great degree, these ex-ante safeguards against FPI information asymmetry are already there through this combination of rules, SROs, and market demand. Now, the third vector supporting the system is the risk of liability. U.S. class actions are unique, and they are a powerful disciplining mechanism for FPIs. Years ago, Chair Levitt testified that class actions were an important helper of the SEC. That's no different with FPIs in many respects. FPIs represent a substantial share of U.S. securities class action filings. The data are very clear on this. The risk of private class actions is substantial. To outline a few determinants of the litigation risk, first, there is the type of listing, specifically, or trading, OTC versus various types of exchange listings. This is something directly within issuers' control, and issuers can opt into that. Now, exchange listings do carry significantly higher litigation exposure compared to OTC trading. This reflects both the greater visibility of the issuers and the ability of the plaintiffs to plead reliance on efficient markets under the fraud on the market theory. This phenomenon is very similar in the domestic issuer litigation context. More visible companies get more attention, and the risk of litigation may be higher. So this is economics 101. Now, there are also jurisdictional factors, and this is where there is a gap in private litigation. Here I agree with Dan. FPIs from countries geographically distant from the United States, so not just China, or countries with weaker judicial efficiency at home may be less frequently targeted because plaintiffs face higher enforcement costs. But importantly, the markets are still efficient. They adjust to that. For example, some data indicate that litigation against FPIs from a certain jurisdiction can negatively affect the valuations of its peer companies domiciled in the same country, especially those from weak investor protection regimes. So the markets in the United States are efficient for a reason. They react to information. Now, the litigation triggers for FPI class actions are very similar to what we have in the domestic context as well. When foreign firms experience events like accounting restatements, missed forecasts, sharp stock price declines, they're just almost as likely to be sued as U.S. firms facing the same triggers. But yet there is a gap in the litigation regime, and to be honest, this is where the SEC could have come to the rescue. Unfortunately, the SEC's resources are limited, and it translates into selective enforcement against the FPIs. My own research suggests that the Commission often targets FPIs that face reporting obligations or already have high investor visibility and risk of class actions. Those in OTC markets may face less scrutiny compared to exchange-listed issuers. In short, both class action litigation and SEC enforcement risks are concentrated among a subset of higher profile firms. So, at the very least, If the Commission believes there is a problem with the existing FPI regulation, first we need better analysis of what the problems are to avoid those spillover effects, and simultaneously we need to think about the changes in enforcement. FPIs are critical to the U.S. economy and exchanges, which supports this need for extra vigilance, even though a full-blown reform may be unnecessary. FPIs hail from all over the globe, as we know, and they are very heterogeneous in their motivations to list. So why do they come? First, there is the bonding hypothesis, which actually still stands. There has been a lot of criticism of the bonding hypothesis, but there is also empirical research supporting it. Foreign firms list in the United States to bond themselves to stricter governance rules and investor protections, especially where home country institutions are weak. By submitting to SEC oversight, U.S. disclosure standards, liability rules, issuers commit to higher transparency and lower expropriation risks for minority shareholders. Think Russia or China, for example. Cross-listed firms command some valuation premiums and face lower cost of capital, especially when they list on U.S. exchanges. So the markets do react to that. And there is some evidence of bonding. Empirical data indicate valuation premia, higher Tobin's Q, lower cost of capital, et cetera, et cetera. So scholars also find greater liquidity improvements and reduced trading costs for all firms, but particularly for firms from emerging economies compared to those from developed markets. So I'm not surprised that Chinese firms in search of capital, and China is a vibrant economy, they are coming to the United States, they're flocking to US exchanges. It's not just because they want to rip off American investors, it's because they are trying to tap into the most liquid market in the world. US markets are deep, they're liquid, they offer access to large pools of sophisticated investors. And they're very attractive to emerging market firms with illiquid domestic exchanges. Being listed on the New York Stock Exchange or NASDAQ also signals quality and generates reputational benefits, enhancing relationships with customers, with partners, with investors as well. There are also capital raising motives, so that's another theory. Many foreign firms list to facilitate equity or debt offerings. Listing provides credibility for the so-called follow-on offerings or cross-border acquisitions. And there are also strategic and operation goals. Firms may cross-list to ease mergers and acquisitions involving U.S. companies, and access to U.S. stock markets makes share-based transactions more practical. So the benefits that FPIs derive from this access to the United States are conditional. They're not universal, but so are their risks. And perhaps the easiest way to find out the lemons among the FPIs, including microcap Chinese firms incorporated offshore, would be to start with a flexible approach. SROs, like NASDAQ, have already proposed one. Another one would be for the SEC to change its very lenient enforcement tack in FPI enforcement and maybe develop a targeted enforcement program to detect potential problems. Given that the market reacts to SEC enforcement, and of course there are multiple studies supporting that, they would adjust the valuation and scrutiny of similarly situated FPIs. And obviously, such enforcement would be supported, as Chair Alder mentioned, through the IOSCO's MOU. By contrast, and this is where we need to be very careful, a major rulemaking on FPIs without first identifying a clear overarching problem would expose the SEC itself to the risk of APA challenges, Administrative Procedure Act challenges. With a group of co-authors, one of whom is a former SEC commissioner, we're examining decades of rulemaking challenges and APA litigation. Our empirical analysis connects the feedback from the notice and comment process to the outcome of legal challenges to SEC rules. We explain that participation of various shareholder groups and stakeholders in comment submission leads to their impact on the judicial process and also sheds light on how rules fail in court. So far, the preliminary comments right here, filed in reply to this concept release, suggest that many stakeholders may resist future rulemaking efforts, potentially leading to judicial challenging under the arbitrary and capricious standard. I think the SEC would not want to face the risk of being overturned in court, particularly if the problem can be, for the most part, taken care of by enforcement, by market practices, by the SROs themselves. And in terms of enforcement, obviously the SEC's Division of Enforcement is probably the best in the world, and it is assisted by rigorous economic analysis, and provides a very flexible regulatory tool which can fill the gaps in the general FPI regime while the SEC is working on how to adjust the regulation FD and the other, let's say, minor regulations. Thank you.
All right, thank you, Yulia, for this illuminating presentation. So before we turn to Helen Boyd, I just want to remind everyone who's watching on the webcast and people in the room that the Investor Advisory Committee has its own comment file. So to the extent there are any reactions or comments to any of the discussion, we would very much welcome comments from stakeholders, investors, and so on, and we'll consider those as part of any potential recommendations in this space that we may consider. So with that, I turn it over to Helen Boyd.
Thank you very much, and thank you very much to all the other presenters today. It's been fascinating to hear the different perspectives. I think, as Ashley has already alluded to, the FCA is strongly supportive of the concept behind the FPI, and in fact, UK firms also very much support that, as can be seen for their responses to the concept release. An appropriately calibrated FPI is an important part of the proportionate growth and orientated regulatory system that we need to see capital being raised efficiently on a cross-border basis. And we believe that a well-calibrated FPI regime can also help drive down some of the costs that can come about for duplicative regulation, which is, again, a positive for the markets. It allows issuers to more easily access capital. It allows investors a greater diversification of investment opportunities. Now, having listened to everything this morning, there's obviously some questions that have different views on what the scale is and where the problem might be here. But one thing's also been alluded to, and I'm going to defer to the panel and the committee itself on what their answer is around that problem. But the other thing's been alluded to is that where there is an unintended consequence, we do need to be aware of that. So as I've said, the FPI is relied on by UK firms quite extensively, and also very kindly, many of the presenters have alluded to how the UK is seen to be great and high and robust and has great framework. And I do want to just briefly sing the praises of the UK. It is, after all, my home state. We do have a very strong regime. And one thing I do want to just call out is that it is across the board on all the things that were mentioned by Dan in his presentation. We have an extremely strong and robust market abuse regime. We do have very strict rules around disclosure of material information. We have very strict rules on how that information can be shared, even in private conversations. We have very strict rules on when that information has to be disclosed. We also have a very embedded set of legislation that's been around for many, many decades, from the Companies Act, which talks to how all firms in the UK, incorporated in the UK, have to act with regards to corporate governance and other aspects of disclosure, including financial reporting. And on top of that, we have a set of listing rules, which I'm personally responsible for, which make sure that our listed firms adhere to the highest standards possible of disclosure to the market and a timeliness and cooperation with the regulators and with other public bodies. And overlaying all of that is a supervisory and enforcement approach where we do not shirk from taking action where we see bad behaviour in our market. So another point that Dan made in his presentation is that need for an enforceable part of the regime. All of that, I would say, is present in the UK regime and framework. So wherever you come down on the question of where the problem lies in this market, I would suggest there are places it does not lie. And I would say it does not lie with your UK FPI cohort. So how you address that, I think, is going to be the interesting question, because we would like to see a regime here that continues and is consistent with how our issuers have already approached this. We find it a useful source of capital for our market. We think that issuers would continue to benefit from being able to access it. It would be great to have a regime that is simple and clear and consistent. So by which I mean there have been points made about the dynamism of some of these market tests. that can be problematic where people drift above and beyond thresholds that is difficult to keep track of. Some of it is not controllable. As Ashley said, we believe a jurisdictional assessment can be a good approach here. I appreciate fully that that is not a light ask and there will be resource required to do it. But I think the concern would be that you end up with a blanket approach where you end up excluding perfectly legitimate companies from a market that they wish to access and which your investors wish them to be part of. Perhaps a jurisdictional assessment can be part of your solution here. It may not be the full solution, as Ashley said as well. We see it as sitting alongside as an alternative approach in certain circumstances, but you may also need to have other aspects. I'm going to end my remarks here. I think you've heard a lot from people this morning, and I don't want to repeat what other people have said. So thank you very much for including us this morning. We found it very useful to hear the different perspectives and really open to hear any Q&A as well.
Thank you, Helen, and thank you to all the panelists. Really, this was terrific. So we have about 30 minutes left. I want to have a robust Q&A. Before I open it up to the room, I have just a couple of quick questions for our panelists. The first question is for Chair Older. You mentioned potentially a greater role for IOSCO or looking at the MOUs around enforcement. I'm just curious, in your view, not just as a UK regulator, but also longstanding observer and participant in international capital markets, are there any resource constraints or knowledge constraints or kind of any other frictions that may make this a little bit difficult, and how feasible it is to anticipate or to rely on cooperation among jurisdictions in this space?
Well, it isn't straightforward. Very often there are legal impediments on sharing information across borders, which we're quite familiar with and around which there's been a fair amount of debate. I do think, just coming to, the mechanics, as Helen said, we are in favor of a jurisdictional assessment for the reasons that we advanced. We fully understand the resource and other implications of doing that. I think if you look at the sort of the totality of how jurisdictions from a regulatory perspective operate vis-a-vis each other, you fundamentally have three concepts, one of which is international standards. Now, the issue with international standards is, are they going to be implemented locally at all or uniformly? I'll just leave it there, but that's the issue. After the financial crisis, a very, very large measure of consensus around rules to address and approaches to address what happened. And that obviously diminishes over time. That's the reality with international standards. The other way in which, principal way in which, or the second way in which jurisdictions work together are arrangements around either unilateral or reciprocal market access, which is kind of what we're talking about here. And that can be based on a number of criteria. The criteria in the which we're talking about today tend to be quite bright line tests around to what degree are you a foreign company. I wanted to associated tests, but that's fundamentally where it sits. The issue with assessments of jurisdictions as to whether they're up to scratch effectively to enable companies based there to list elsewhere, or indeed mutual recognition, which is also mentioned in the concept release, is twofold. The first of one of which I alluded to, which is initial assessment. And I do think actually there has been a lot of work done over the last actually quite a few years, which has been aimed at working out what sort of common templates or approaches should be used in relation to that. And then secondly, to come into your point around exchange of information, it is important, and we need to recognize that that markets are dynamic, they change, the rules change, etc. So having a baseline of information exchange, again, usually through MOUs or similar, is important. The IOSCO MOU is a subset of that because it's fundamentally to do with exchange of information in an enforcement context. of course, there's a supervisory context as well. So that's now all of that, I think, has been, as I say, the topic of quite a lot of attention and discussion over some years. Some of it's successful, some of it not so successful. But ultimately, I think there is reason to be able to do a bit more work around this, without doubt.
Thank you so much. So I have just two questions left for the panel. The first question is for Professor Taylor. So Professor Taylor, you made a very compelling case that there are real problems. And I'm curious whether you've heard any reactions from investors that they see these as real problems and they have been harmed by FPIs. What is the feedback, if any, you're getting from investors?
I think it's mainly jurisdictional in nature. I think, you know, if you go back to 2016, 2018, there was a wave of Chinese reverse shell games, reverse mergers in the U.S. that prompted the China hustle, and investors were getting hurt then. And, you know, I've heard plenty from investors who participated in, you know, pump and dumps. I'm kind of, you know, surprised. I guess I live in a little bit of a bubble at Wharton. You know, some people, when you get a text, invest in this company, they invest in the company. And so I do think that, you know, investors, U.S. investors, are unambiguously being harmed by sort of the FBI regime from certain jurisdictions. You know, and I think, you know, I think the data bear that out. And so, you know, whether that means a wholesale rethink of the FPI regime, you know, I leave that to you all. But I do think that the data show that there are very, very, very bad apples out there. But yeah, I mean, absolutely, you know, there's plenty of folks out there that have been hurt. If, you know, again, go to that Stop NASDAQ China Fraud website and look for yourself about people who have lost, you know, fortunes investing in these pump and dumps. The one thing I will say, just to respond to maybe like, you know, NASDAQ can handle it, it cannot. You know, NASDAQ responds to political pressure, gender diversity rules, now, you know, China, so, you know, it blows with the winds of the administration. Their proposal is to increase minimum market cap threshold to 25 million. You know, we just talked about Regenicell, and they wiped out 33 billion in one day. NASDAQ is an SRO. What that means is it is shielded from private litigation. So as a private citizen who invests in a NASDAQ IPO, I cannot sue NASDAQ. And of course, NASDAQ gets listing fees from the more companies that get listed. And so, you know, regardless of what actions you all take, the one thing I tell my students is you should consider the incentives of the person that you are listening to, whether it's an academic like me or someone like an exchange who makes listing fees, corporate attorney, think tank, left or right. Always think about, you know, the incentives of that person and what they're advocating for. Thank you.
Thank you for that. And piggybacking on a point you made, I'm curious whether any of the panelists have thoughts on the role of gatekeepers or intermediaries. So it is true that NASDAQ cannot be sued for any losses, but underwriters can. And so can auditors and so on. And so is there any failure in the gatekeeper regime, and could the gatekeepers here, the intermediaries, be doing more? Yeah, Chair Alder.
I'll just reflect on experience. In a former role, I was in Hong Kong. I was the chair of the market regulator there. Hong Kong, over the years, became its stock market became dominated by mainland China corporates, as distinct from domestic Hong Kong companies. We did have the equivalent of regulation FD applying to those companies, and there was no resistance to that. But the more important point is that there was a view, this is some years ago, that underwriters or sponsors were effectively overtrading in the listings or the IPOs of mainland China companies in Hong Kong. And in doing so, they were not kicking the tires sufficiently. So when I was just listening to the remarks of Daniel's remarks, I was reflecting at the same time on that history and the question of where overall responsibility lies across, you know, the group of actors, whether it's the company itself, whether it's the directors, whether it's the investment banks, the sponsors, the underwriters, etc., when bringing a company to market. And I just would invite you, in thinking around this problem, to have a look back at the history of what happened in Hong Kong. Fundamentally, we tightened the rules and we engaged our enforcement powers to ensure that the sponsors fully understood that they needed to kick the tires.
Thank you for that. Anyone else want to weigh in on that particular question? Yeah, Yulia?
So, as I mentioned before, SROs such as NASDAQ and the New York Stock Exchange do have relatively extensive authority and an opportunity to monitor their listed companies. They can suspend trading, they can delist companies, and the SEC could apply pressure on the SROs to pursue those actions more aggressively. But the second point I wanted to make is that market crashes do happen. We did have the dot-com bubble, and those, as far as I remember, were mostly US companies. So the fact that we have a lot of Chinese IPOs, well, with prices going down from time to time, doesn't mean that every single Chinese company is fraudulent or doesn't have a considerable business potential. We just need to look a little bit more into this problem and to separate out, let's say, oranges from bad lemons.
All right, so I would like to open it for questions from the rest of the committee. Colleen?
I was curious if other folks on the panel had reactions to some of Dan's suggestions, particularly about Section 16 reporting.
Yeah, John?
So I think, again, a really important point to make is that many companies that are dual listed in the US already are subject to similar reporting obligations. And I appreciate that US investors may not be able to go to the same place on the SEC website to find them, but it is as easy in all European jurisdictions in English to find reports of sales for what are referred to as persons disclosing management responsibility, which is very close to the definition of executive officer. You know, I really take Dan's points as being focused on Chinese issuers. One question I had for Dan is, because a significant number of China-based issuers, and especially the bigger ones by market capitalization, are also listed in Hong Kong. Do you see any difference between the universe of issuers that are listed in Hong Kong compared to the ones that are only single listed in the US? Or I just wondered if you'd looked at the data in that way.
Thank you. We have not done a cut of China versus Hong Kong.
Yeah. It's interesting because obviously one potential outcome here is that the companies that are subject to a second listing may not be subject to any changes. That's one of the things we were discussing potentially in the context of London, for example. But it would be interesting if that excluded then a significant number of China-based issuers which are listed in Hong Kong, but did not exclude some of the European companies that are only listed in the US. That would be an odd outcome perhaps for those companies. Just sorry, one other quick point on Section 16. There are two parts to Section 16, Section 16A and Section 16B. Section 16A is the bit that I think, Dan, you were mainly talking about. That's the reporting section. When the legislation that Dan referenced was proposed, I don't think it was limited to Section 16A. I think it included Section 16B as well. Section 16B is what's referred to as the short swing profit rules, which is a very complex set of rules that apply to US domestic companies regarding the purchases and sales of securities in a 6-month window. There isn't really an analogous provision to that outside of the US, as far as I'm aware. But it would from an administrative perspective, it would be very complicated to introduce that at foreign companies. So I guess one question I have for you, Dan, is whether the sort of presentation really focused on the disclosure. I understand that. Do you also see significant value in the short swing profit aspects of 16B, or do you see 16A as the key sort of aspect?
So for those that aren't aware, the short swing rule, I would describe it as in effect prohibiting day trading by the executives. So if an executive sells stock and then buys within the next 6 months, the difference in price they have to disgorge back to the company. Or if they buy and then sell within the next 6 months, they have to disgorge and buy or disgorge back to the company. So this really comes into effect when you have activists or you have executives or people who are trying to flip the stock. I understand that, people don't like that rule. It is kind of a boon for the plaintiff's bar. It is, it's just disgorgement. You don't actually normally go to trial over it. I don't really have strong feelings about it. I think the reporting is where most of the action is, but at the same time, if somebody said, hey, should we apply Section 16B, I understand it would impose a huge burden. And so that's why I didn't really focus on it in the talk. But from a benefits perspective, I do think there might be benefits. But again, if the executive is day trading the stock, it's probably not a company. You'll see that in the Form 4s if it's reported, and you'll be able to detect it and price it. Whereas right now, they could be day trading, and you wouldn't even know it.
Yulia, you wanted to jump in?
So I both agree and disagree with John and Daniel on different points. On the fact that foreign jurisdictions do require disclosure similar to Forms 4 and 5, if it's indeed comparable, then perhaps because the markets, as I mentioned before, are informationally efficient, some market analysts, which are following US-listed firms, they would dig it out and the information would be impounded into the share prices. But on the other hand, if the information is opaque and unclear and in multiple foreign languages, it may be hard to get this information properly priced. And also forms may differ among jurisdictions. So I'm not averse to 16A reporting. On 16B, that was a compromise. Our Congress didn't want to prohibit insider trading altogether, so instead they went with 16B. Obviously, only I think a small number of law firms are looking through those forms, and they are bringing 16B actions. And in fact, we have a very strong insider trading case law under Section 10B and Rule 10b-5. So this is what's kind of driving insider trading litigation. That's why I don't even think that 16B would be that valuable because of the stronger insider trading litigation in the United States and enforcement.
Great, thank you. I'll now turn to James Copeland. You wrote James, welcome to the committee, and you put in a very interesting comment letter in the file, which I read. So look forward to your question.
Thank you. Yeah, my colleague Jared Dieter and I did a short comment letter in response to this, and I guess I've just got a bit of follow-up to Professor Taylor and just some questions here because I don't view it as necessarily ipso facto evidence of investor harm that certain insiders of the companies are making off like bandits. I don't mean that to suggest that we shouldn't have writ large some insider trading or Reg FDs here, but from the perspective of an investor, and we're here representing the investor point of view, I'm much more interested in what sort of investment opportunities I may or may not have access to, particularly may I or may not have access to opportunities that are less correlated to the broader, say, S&P 500 big U.S. company stock market. And I tend to instinctively agree with Professor Guseva's point that a lot of this is going to be impounded into market prices already. There was a debate at the commission and in academia 50 years ago over state incorporation, and there are people on the SEC saying, well, we need to nationalize this and get rid of state and federal incorporation, and my mentor, the late great Ralph Winter, under whom I studied, for whom I clerked, wrote a really, I think, significant piece on this, saying, well, no, wait a minute. I mean, investors know where you're incorporated. That's pretty easy to determine. So we know China and Russia, there's going to be shenanigans. Given that, we're going to take that into account. So when I went to my law school housemate's wedding in China in 2006, and he's a big investment banker and now leader of equity markets in China, I was asking him about Chinese companies I might invest in. I knew damn well that there were going to be potential shenanigans, but I also wanted to get a piece of this market, and I did, and I made money. The question here is, I guess, therefore, do you have evidence beyond, say, a 1 year, you basically showed a 2024 to 2025, a 1 year IPO window showing negative median and mean returns. And my understanding of the data from NASDAQ is that on average IPOs have negative returns in 1 year. And so I wonder if there's A, is there more cross-sectional analysis? B, is there better long-term time series analysis that both compares over different time windows other than 24, 25, and compares this over the longer run other than just a year? Because the reality is you expect, if you're investing in these sorts of markets, to lose most of the time, but you're going to get some big hits. And this is the sort of opportunity I wouldn't want to foreclose for U.S. investors. So I'd like more data before we understand that there's a problem from the investor perspective. I'd want to see more data than just, oh, most of these lose money in year one.
Thank you for that question. Is it possible we can throw my deck back up on the thing?
Yeah, we can try.
Okay.
In the meantime, I'll just point out that we're the Investor Advisory Committee, but we do not provide investment advice.
Thank you. Yes. So while they're working on throwing the deck up, so in the deck there is, I covered it quickly, there is older evidence. I just did a refresh just to make it, I say topical, but we can cover some of the older evidence that's in the deck when it gets up there. I think this philosophically, like, do we want U.S. investors to access outside opportunities, as you said, diversified beyond the U.S.? I think the answer to that question is yes. So then it becomes a question philosophically of how much safeguards we want. One viewpoint, I'm not trying to judge these viewpoints, is, the market is a casino, you invest at your own risk, you know the risks, you put everybody looks at the prospectus and says it's a Cayman entity and it's a variable interest entity, like it's priced. One of the things that I would say about that is that note that there was disclosure in the first place. There was disclosure on the prospectus. Hey, this is a variable interest entity and it's incorporated in Cayman, right? So like this goes back to an example that I've talked about with some of my students is should we require restaurants employees to wash their hands? And one example is to say, no, you just post a sign on the outside that says at this restaurant, employees are not, don't have to wash their hands and let market forces sort it out. But that, again, requires that there's that disclosure that up there. And so, like, for me, I don't think of disclosure as being particularly burdensome. In terms of the investor perspective, if you had Form 4 reporting, it would potentially, well, I can't yet control this.
Just let me know which slide.
Go to the nice normal distribution plots of IPO returns. I don't know if it's before or after this. It's before it. Oh, here we are. So this is from 2011 to 2020. So this is what I was updating. So this is basically saying 12-month from 2011 to 2020, half of all of the U.S. listed Chinese companies lost more than a third of their value, and then we look out 3 years.
That's for median. Do you have means on those?
They're
longer term?
I do not. They're even. I mean, they're skewed because of the giant. Like the left tail here is massively negative. So the medians would actually be. The means would actually be more negative than the medians, if that like makes sense, right? Like if 50% of my students failed, and I look at the average grade, it's going to be, you know, really, really bad. Anyway, I think philosophically it's a point of how, you know, like how investor protection do we want to get? Do we want to say you can't invest, like these aren't on the market, you don't allow these companies to list? Or do we say, okay, they list, but provide some information? To the Form 4 point, if you could go to the all the stock drops for the pump and dump, the Form 4s would potentially allow investors to avoid the stock drops, right? Keep going. You're going backward. Go forward. Right. So like, what's happening in that dump? Right. Like that dump serves the insiders because the insiders are potentially dumping. So you get like potentially an early warning signal. So I take the point. You know, we want choice for our U.S. investors, but at the same time, you know, it's a 30-minute forum. So
Great. I'm going to jump in here, and thank you, Adam, for helping us navigate the PowerPoint. This was very helpful. So I'm going to turn it over to Brian, and then we have Andrew and Andrea.
So, Dan, following up on one of your questions, I'm curious, or suggestions, I'm curious how some of the other panels react on the materiality concept. If we overlay the U.S. definition of materiality and onto reporting obligations and accelerate it or put in a finite, definite time period for filing, you know, a 6K, what would your reaction be? It would mean that there would, you know, conceptually what we'd have, right, is we'd have information being given to the market, material non-public or material now public information being provided to all investors so that all investors can make intelligent investing choices. Is that a burden, do you think? I mean, obviously, in countries or jurisdictions that do have some sort of reporting, this would just mean now that it might be accelerated, it might not be, but at least all investors in the U.S. would now have an opportunity to know what might be important to them in their investing decision.
I guess you're quite right, Brian, that one of the concerns there is that for companies that are already subject to an obligation, which includes every company in Europe, I believe also the ones listed in Hong Kong are subject to a similar obligation to the MAR obligation in Europe. It would be in some ways duplicative, and so it just becomes a burden. And so when they're thinking about dual listing, there's already a number of situations where they're required to follow a home country regulation and a US regulation which overlap, but effectively result in twice as much work, perhaps because they can't just go ahead and submit the same form. The great thing about 6K, of course, is you can just take what you file in your home jurisdiction and file it in the United States. And for many companies, it happens automatically without them having to think about it. The odd thing about 8K as well is that it is prescriptive in terms of what you need to do, but it's quite actually a limited set of events. You know, so if a super material litigation is filed against the company, there's no 8K requirement to disclose that, which to a European regulator would be quite surprising, I think, because they would say, well, hold on, you know, the reason we have the market abuse regulation is absolutely so that a company has an immediate obligation to disclose that kind of event. So actually, you know, introducing 8K is quite different from the way that many foreign jurisdictions think about it, and the set of events is actually not. I think you gave the example of a CFO change or resigning, which certainly would be covered. But I think, you know, many foreign investors, and I suspect even many US investors, may be surprised about what's not covered by those forms.
Perhaps we need to think about changes to Form 8K as well. Yulia?
If I may add to that, I agree with John, and also wanted to point out that the definition of materiality, which obviously in the United States was a product of case law and TSC Industries, that definition is pretty similar across jurisdictions. It is information affecting investors' decisions to trade, basically. So there is similarity right there. And an important point that John made is that in the United States, not all material information should be disclosed. There should be a duty to disclose, which mainly comes from Regulation SK, as well as the liability provisions and the obligation not to provide only half-truths. But except that, not each and every piece of material information should be disclosed. So there are those limitations as well. And as George mentioned, the AAK is, and John said that as well, AAK is also a relatively limited document.
But perhaps here we should note that under the stock exchange listing rules, there is actually an obligation to disclose material information in real time.
In a timely manner, absolutely. Both NASDAQ and the New York Stock Exchange have that.
Yeah, so we do have something approaching an obligation in the U.S. to disclose all material information, even though it doesn't come from the securities laws.
That could be one of the reasons why the average numbers of 8Ks and 6Ks are pretty similar.
Perfect. Okay, so we have just a couple of minutes left. Andrew and Andrea, maybe you can ask your questions in one after the other, and then we'll give the panel the last word.
Sure. Thank you to the panelists. One of the pieces that I'm trying to reconcile here, I mean, Yuli, you mentioned the differences between oranges and lemons here. I mean, the irony I see here is that due to some of the jurisdictions that were mentioned, you see U.S. investors who have been very interested in companies that are based in the UK, France, Germany, and Italy, and I'm referring to defense stocks, right? Ones that are not, if the investors don't have access to foreign exchanges, one of the ways that they do have access is through over-the-counter. And so, there are some potential, there's been investor interest and we've seen a lot of capital flowing that way. But on the flip side, obviously, some of these other issues have been raised for the lemons. And so my question comes to the incorporation then. Given the fact that we have companies who are, who their headquarters are understood to be in certain jurisdictions, but, are using, incorporations in the Cayman Islands and the British Virgin Islands, are there, supporting cases as to why that's beneficial for issuers, as to why we should continue that basis versus, having to use the headquarters as a, as the incorporation?
And then my question is about, probably for you, Professor Taylor. I was curious if you had any data on who is buying and who is selling the Chinese pump and dump schemes, because you said, as an example, someone gets a text and they buy it. And my experience is in the retail market, they're not looking at the 8K, they're not looking at the disclosures, they're not looking at Form 4s. And so if we do implement some of these reforms, is it really going to protect the victims in those cases? And if not, what do we need to do? Is it really more of an enforcement issue versus a disclosure issue?
Sure. Maybe I'll take the first question. Andrew, there are a number of different reasons why issuers can be incorporated in a different place than the headquarters. Often they're very technical. For example, we worked with an issuer which wanted to list in its home market and in the United States, and it wanted to list ordinary shares in the United States rather than American depository receipts, which is a sort of a trend for companies over time. And it's seen that US investors are closer to the stock, and so there are some benefits to doing that. They pay less fees, so there are investor benefits for doing it that way. But because of the way the clearing systems effectively talk to each other, it's not possible for a company that's organized in the place of the headquarters to list its shares directly in the US and then have a listing in its home country. And so effectively a third country was just identified for the purpose of being the jurisdiction of incorporation. So that's one very technical reason. And then there are tax reasons as well. There are tax reasons often why a company will be incorporated and perhaps tax resident in a place that's different from its headquarters. That certainly has its own, there are policy arguments regarding that for sure, but I think they're separate policy arguments from the policy arguments we're discussing here. And then, finally, when you compare the listing venue to place of headquarters or incorporation, they could often be different. There are a number of companies in Europe, for example, listed in London because their home country is just so small that there isn't the depth, even if there is a listing venue there, the depth of the capital market system is not significant enough. So there can be a lot of different reasons for it, other than, in addition to potentially taking advantage of regulatory arbitrage and the fact that the corporate governance regime in that country is less significant.
So Andrea, to your question, or maybe a comment. So a couple of things. First, the Form 4s that have the trades, I agree. I think most of my friends aren't going to the SEC's Edgar website to download it. But there's what's really interesting, and one reason why those download counts are so high, is because the brokers are automating it. So if you open up your Robinhood app, which I'm sure everyone has here, and you punch in a ticker, you can scroll down to the bottom, and it actually has the insider buying activity right there for that ticker. Because it's something that retail could actually understand, as opposed to like, oh, their accounts receivable or they're payable or something like that. Not putting retail down at all. I do think it's an enforcement issue, but enforcement is very difficult. I cannot overstate that enough. You know, if you have a foreign broker and the records are, and you see WhatsApp chat groups and the IPs are coming from China or from a foreign jurisdiction, there's not actually a way to actually track that back. So, you know, the SEC did stand up a cross-border enforcement agency. DOJ did make it a priority. But I do think, I don't know who's on the other side. The SEC and the DOJ do, because they have things called blue sheets that show who's actually taking the opposite sides of these trades. There was a recent DOJ action against, I forget the name of the company, but the ticker is OST, which is a Chinese issuer related to one of their equity offerings. And there, the FBI actually put out a website calling for victims to come forward. But, you know, in terms of public data on who's on the other side of that trade, you know, we don't have any.
All right, we are out of time. And I want to thank all the panelists for this very, very illuminating discussion. We'll continue in the afternoon, but before that, I'll turn it over to Brian.
Thank you to all of our panelists. Our morning session is now concluded. You provided valuable perspectives and an engaging discussion. We'll break for lunch and an IAC executive session, and our public portion of the meeting will resume at 2:30 p.m. with part 2 of our FPI panel. Thank you very much.